We're naturally drawn to this idea of stillness. There's this deeply ingrained instinct in us that assumes if we just lock a resource away and never touch it, it's going to stay exactly as it is, forever. Well, in this explainer, we're going to dive into what is essentially financial physics. We aren't here to give advice or tell anyone what they absolutely must do. We're simply going to quietly observe the natural patterns of wealth, value, and time. If we just look at the natural world, it reveals a pretty undeniable reality about our resources. Nothing actually exists in total isolation. Even when something looks perfectly still, unseen atmospheric pressures are constantly at work, quietly evaporating the very things we assume are completely safe. Take a look at the concept of perceived safety. It perfectly mirrors how we interact with stored value. When you pull up an account and check a balance, the number itself hasn't moved, right? And that creates this incredible feeling of absolute security. But here's the catch. The environment around that number is constantly expanding, putting massive invisible pressure on it. Section 1. The invisible force, hidden inflation. So publicly, we're told to measure this pressure as a gentle little stream, a broad 4 to 6% index. But, well, human lives are lived right on the riverbank. The official number might feel like a gentle breeze, but real-world erosion, especially if you had to pay a college tuition bill or looked at a housing contract lately, that is a strong, persistent headwind. The actual costs of profound, everyday human needs are surging at a much, much more aggressive pace. When we park our value in a space we perceive as safe, like a standard savings account, it instantly hits a wall of standard taxation. And then, that surging river of real-world costs just washes right over it. The true everyday trajectory of that safe money isn't actually growing. It's experiencing a quiet, invisible decline of about -3% every single year. The digits haven't changed, but their gravity absolutely has. Money left completely alone doesn't shrink in numbers. It shrinks in mass. The exact same unit of value simply can't lift what it used to because the weight of life's requirements just keeps expanding. It's like the muscles of that wealth have completely atrophied. Section 2. The environments of wealth. So where do we go? Historically, human beings have always sought refuge in density, heavy, elemental assets, like gold. Now, this environment isn't trying to conquer the river. It acts more like a massive, ancient shield, designed just to hold the line and match the rising water. It's a historical reflex, basically trying to maintain an equilibrium against the slow leak of paper currency. Then, we pivot to a completely different strategy, real estate. A whole new pattern emerges when we deal with the physical earth. It's an environment defined by immense friction. You have to sacrifice a tremendous amount of immediate energy. Think heavy registry fees, massive initial capital, and incredibly low liquidity, just to break the soil. The trade-off here is remarkably clear. You are giving up the ability to move quickly if the winds suddenly change. But in exchange, your value grows deep, deep roots. It anchors itself securely into the physical expansion of the world around it, becoming this massive, slow-moving, inflation-resistant anchor. And then there's the environment of pure human output, the stock market. Forget the idea of a chaotic casino for a second. What we are really observing here is thousands of entities waking up every single day, innovating and solving problems. It is a flowing river of collective human productivity. Now, if you get up close, this environment looks terrifyingly violent and unpredictable. But when you step back and observe the pattern over decades, it's incredibly revealing. While the daily news is obsessing over those terrifying red dips you see on the timeline, zooming out shows that short-term turbulence almost inevitably fades into a quiet, relentless upward trajectory. It's right here, in this active engine, historically producing around 13.5% over the long haul, that the energy generated finally outpaces that hidden evaporation happening on the riverbank. Uniquely, this environment also introduces this incredible concept of deferred momentum. See, static savings are constantly bled by the friction of yearly taxes, a drag that constantly interrupts your growth. But in equity environments, taxes are usually applied only at the exit, so the mass is allowed to just roll. It gathers momentum and compounds entirely uninterrupted until you finally decide to step off the ride. Section 3. The pattern of time. Ultimately, the defining metric across all of these environments is velocity. Have you ever heard of the rule of 72? It's fascinating. In a 7% environment, your wealth essentially doubles in size in roughly 10 years. But if you bump that to a 12% environment, in that exact same decade, it doesn't just double, it triples. The environment you choose literally alters the physical density of the outcome. It's like the old adage says, compounding isn't some mathematical trick, and it's certainly not a temporary loophole. It is simply the natural behavior of sustained energy when you leave it alone in a fertile space. True wealth preservation is just a matter of aligning your resources with this natural law. We exist in an ecosystem of constant motion, and mathematically speaking, standing still is exactly the same as moving backward. Observing these hidden currents and the wildly different mechanics of the assets we have available to us leaves us with a pretty quiet realization and one ultimate question. Knowing all of this, where will you choose to place your resources for the future?